Most people believe their financial stress comes from not earning enough money. That sounds logical, but it is not true. The real problem is not income, it is time. And more specifically, how long you agree to stay trapped inside debt without ever questioning the rules of the game. There is one payment almost everyone treats as normal, responsible, even smart. It feels safe. It feels adult. And yet it quietly delays financial freedom by decades. I am talking about the 30-year mortgage. If you have one, this is not a criticism. You did what you were told to do. You followed the system exactly as it was designed. But today I want to show you how that system actually works, why it benefits the bank far more than it benefits you, and how you can completely change the outcome if you are willing to think differently. Not emotionally, not dramatically, strategically. Let us slow this down and reset the conversation. When someone signs a 30-year mortgage, they believe they are buying a house. What they are really doing is agreeing to rent money from a bank for 3 decades. The house feels like the asset, the loan feels like the tool. But in reality, the loan is the product, and you are the one paying for it every single month. Here is how this usually plays out. You buy a home. You make the payment. You repeat this process for years. Life happens, time passes, and one day you realize you have been working for decades, yet your flexibility has not increased nearly as much as you expected. That is not because you failed. It is because long-term debt quietly controls your options. Let me put real numbers behind this so there is no confusion. Imagine a $400,000 home. You do the responsible thing. You put 20% down. That is $80,000. You finance the remaining $320,000 at 7% interest over 30 years. Your monthly payment comes out to roughly $2,100. That does not feel extreme. It feels manageable. That is why people accept it without hesitation. But here is the part almost no one focuses on. Over 30 years, you do not pay back $320,000. You pay back over $760,000. More than $440,000 of that is interest. That is not a mistake. That is not bad luck. That is how the system is built. You pay more for borrowing the money than for the house itself. Now pause for a moment and think about what $440,000 could do if it stayed in your control instead of flowing to a bank. That is retirement flexibility. That is investment capital. That is security. Instead, it disappears slowly, quietly, month by month, because the payment feels normal. This is where most people stop thinking. They assume this is just how life works. They assume questioning it is unrealistic. It is not. The real question is not whether you can afford the monthly payment. The real question is whether you can afford to keep the debt for 30 years. Because debt is not just a number. It is a constraint. It limits your choices. It limits your risk tolerance. It limits your freedom. The goal is not to rush. The goal is to exit the game early. Paying off a mortgage faster is not about punishment or extreme living. It is about reclaiming time and optionality. Let me explain why accelerating this process changes everything. First, interest works against you for as long as the balance exists. Every extra year you carry the loan, you are paying for the privilege of staying in debt. When you shorten the loan dramatically, you are not just reducing payments, you are deleting future interest entirely. Second, your mortgage is usually your largest fixed expense. When it disappears, your monthly pressure collapses. That is when investing becomes easier. That is when risk becomes manageable. That is when life choices open up. Third, owning your home outright gives you something rare in modern life: stability. Jobs change, Markets change. Economies shift. A paid-off home does not care. Fourth, debt changes behavior. People with heavy debt avoid opportunity. People without debt can choose it. This is not theory. This is observable reality. So how do you compress a 30-year obligation into 5 to 7 years without magic, schemes, or unrealistic assumptions? You do it by attacking the structure of the loan, not just the balance. The first shift is payment frequency. Most mortgages are designed around monthly payments because that maximizes interest over time. When you switch to biweekly payments, something subtle but powerful happens. Instead of 12 payments per year, you make 26 half payments. That equals one full extra payment every year. That extra payment goes directly toward principal. Not interest, not fees. Principal. This alone can shave several years off the loan without changing your lifestyle dramatically. But this is only the foundation. The real acceleration comes from intentional principal reduction. Every dollar you send toward principal today deletes decades of interest tomorrow. That is why extra payments early matter more than extra payments later. Even small amounts compound aggressively. An extra $300 per month can remove more than a decade from a loan. An extra $1,000 per month changes the timeline entirely. To reach a 5 to 7 year payoff, the approach must be deliberate. This requires two things: expense compression and income expansion. Let us talk about expenses first, because this is where most people underestimate their leverage. Modern life is full of silent drains, subscriptions that feel cheap, convenience spending that feels harmless, lifestyle upgrades that feel deserved. Individually, they seem insignificant. Together, they are powerful enough to keep you in debt indefinitely. The goal is not deprivation. The goal is alignment. For a defined period of time, money stops being entertainment and becomes a tool. This means questioning everything. Do you need multiple streaming services? Do you need a car payment? Do you need to eat out as often as you do? These are not moral questions. They are math questions. Temporary discomfort traded for permanent freedom is a trade most people never seriously consider. Housing itself can become part of the solution. Unused rooms can generate income. Downsizing can accelerate payoff dramatically. Short-term sacrifice creates long-term control. Now let us address income. Most people treat income as fixed. It is not. Time is flexible. Skills are monetizable. Effort has leverage. Side income is not about passion. It is about purpose. Driving, delivering, freelancing, tutoring, selling unused items, or offering simple services can generate hundreds or thousands per month. That money has one job: principal reduction, not lifestyle improvement, not rewards, freedom. Windfalls follow the same rule: bonuses, tax refunds, unexpected income. They do not change your lifestyle, they change your balance. This is how momentum builds. As the balance drops, interest drops. As interest drops, progress accelerates. As progress accelerates, motivation increases. This is a feedback loop. Tracking matters. Watching the balance fall creates psychological momentum. Celebrate milestones, not with spending, but with recognition. Freedom is built through consistency, not intensity. Family alignment matters. Everyone involved must understand the goal and the temporary nature of the sacrifice. This is not forever. It is focused. Now let me be clear about something important. Paying off a mortgage early is not always the correct move for every person in every situation. This is not a command. It is a framework. But for people who value flexibility, security, and control, eliminating their largest debt early is one of the highest confidence decisions they can make. Once the mortgage is gone, something remarkable happens. Cash flow becomes a weapon. The same payment that once went to a bank can now be invested, saved, or used intentionally. Over 20 years, that difference becomes enormous. Millions are not built through magic. They are built through structure. Debt delays that structure. Freedom accelerates it. The biggest mistake people make is assuming there will be a better time later. Later is expensive. The earlier you reduce debt, the more powerful every future dollar becomes. This is not about fear. It is about clarity. If you choose to carry debt for 30 years, understand the cost. If you choose to exit early, commit fully. Half measures only prolong frustration. The path is not complicated. Pay more frequently. Attack principal relentlessly. Compress expenses. Expand income. Stay focused. 5 to 7 years of discipline can change the next 40. That is not motivation. That is math. And once you experience life without that payment, you will understand why people who escape debt early never want to go back. They do not feel richer, they feel lighter. And that difference changes everything.